Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So when I say I'm capitalizing on volatility and tying this together with that bored and confused market, accumulation, distribution, I know there are 4 market cycles. 2 of them are prime opportunities for me to buy, to purchase calls and puts. I do not sell premium, as I mentioned before. The other 2 cycles, mark up and mark down, or what I kind of simplistically called happy and sad, are when I want to capitalize on the movement of what I've already bought. That's going to be when I'm hoping to see the option follow through with my plan. The reason you want to buy in bored and confused markets, and let's get to the wave now. Again, I talked about the 240 and the daily chart. The reason I want to focus on the bored and confused markets and the way I can identify the bored and confused markets is using what I call the wave, the 34 EMA wave. Now, you should be able to set this study up on just about any platform. It's going to help you with your spot trading. It's certainly going to help you with your options trading, because at the heart of any strategy is understanding if it's meant to be a trending strategy or a non-trending strategy. By the way, if you like to buy options like I do, the market environment that you're hoping to benefit from is the mark up, mark down. That's when you want to be, that's what you're setting yourself up to take advantage of. If you like to write premium, you like a sideways, bored, or confused market. That's your friend. That's if you want to write premium. So I don't care what your eventual strategy will be, understanding market cycles should really be at the heart of it. Okay? So my strategy is to buy my puts or calls in that sideways, quiet market. In that way, I'm not paying for volatility, because I'm going to pay for 3 elements. I'm going to pay for one of 3 elements. I'm either going to pay for the strike price being close to the market. I'm either going to be paying for time, giving myself enough before expiration to let my plan run its course, and I'm going to pay potentially for volatility. Now, the reason I call it option shopping is as I look at this market here of the euro-US dollar. Take a look. I mean, there's a lot of moves here we can see. Right? We have this markdown cycle here. There's a lot of emotion behind these. What is a cycle? It's imbalance. Okay? This downtrending cycle is imbalance. This quick uptrending cycle, again, that's imbalance. Whenever you have imbalance, you have a lot of emotion, you have a lot of psychology, and you have a lot of what? Volatility. Anytime the market's attention is on something happening within a trend, you're going to pay for volatility. I don't want to pay for volatility. I'd rather use that part of my premium, use that money to either give myself more time or get a closer strike price. So I would rather take that premium that I would pay for volatility, wait for a lower volatility market, and get better time, put time on my side, or strike price, better location on the chart. So this is not the environment. This downtrend is not the environment that I want to be buying in or selling. I certainly don't want to sell on this either, unless you're selling calls, of course, but I digress. I don't really want to be doing anything. I should already be positioned in the market. Take a look at what preceded this move lower. Okay? See this market back here? Hard left edge. This market right here? This is, I think, arguably a bored to confused market. Range bound, no trend. Okay? Now, the wave I talked about, the 34 EMA wave, you set it up really simply. It's 3 moving averages. I'll show you right now. 3 moving averages. Okay, set on the 34 period, which is a Fibonacci number. Okay? I use an exponential moving average, which weights current prices as more important than, say, further back prices. I set one on the high, I set one on the low, and I set one on the close. And this is the MT4 platform. This is something you can download for free. So that's what you see here on this chart. 34 EMA, one on the high, one on the close, and here you can see one on the low. That's the green, red, and blue. So let me head over to that chat window one more time. And if you guys have any questions, like I said, just please feel free to type them in. I'll keep going back to the chat window from time to time, make sure I'm getting all your questions. Again, the best website, Michael, I recommend you just check out Twitter. That's a great way to keep in touch with what I'm up to on an almost live basis throughout the day when I'm sharing my charts or whatnot. Okay. All right, so just to kind of recap, we're talking about market cycles and how to identify them. All right. Now, if I were to remove these lines, you'd still be able to tell where a market's heading up or down. But there's more detail, there's more nuance to get when you have the advantage, the visual tool of having these three moving averages on your chart. And let me show you what I mean by that. Let's grab another chart. Let's grab another chart for the Euro-US dollar on the daily. Here's that same chart. What I believe the wave helps me out with are these moments in time, okay? When the market is transitioning from one cycle to another. It also helps me gauge how sharp the sell-off or how sideways the accumulation or distribution is. So it's not a matter of I wouldn't know the market cycle without them. I think it's more a matter of the nuances within that market cycle. It just tells a better picture. It gives me it shows a better picture. It tells me a better story. Okay? So as I take a look at this chart, let's kind of identify the market cycles here and what I would ideally like to be doing during the different moods of the market, if you will. So again, we established I don't want to be really doing anything in terms of buying or selling. Me personally, I don't like to buy or sell or do anything in this kind of market mood. I'm going to be paying a lot for volatility because of the imbalance. It's these moments in time, these sideways market actions. We're starting to get that here now. If you look at from the hard left edge to the hard right edge, we're starting to get a little bit of this now, where the three lines are starting to transition to more of a sideways cycle, showing me that I might be getting back into that accumulation or distribution cycle. Okay? So these are the times that I really want to take advantage of buying my call, buying my put. Back here you can see again, when the market cycle starts to transition, when these three lines start to move sideways, that's what I want to take. That's when I want to take advantage of the quiet, the confusion or the boredom in the market, the lower volatility, and that's when I want to buy that option. And I'll do a lot of purchasing in a very short amount of time at these moments to ready myself for what comes next, because for the most part the market will move sideways and then trend and move sideways and then trend again. So to me, the best time to take advantage of grabbing those options is when the market is waiting to go into that next trending cycle. Okay, and again, that's what this wave does for me. Let's take a look at another market again. So the translation for this one would be the EUU. So if you're looking at the Euro-US dollar on your spot, the EUU would be what you're looking at in terms of the option symbol. All right? And this is where you'll see how much you're going to pay for it, where the prices are at for the different strikes. Okay? Which expiration you're going to go for.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.